Hi, welcome to our presentation, Tax Planning Strategies. My name is Rich Stang. I'm a CPA and founder of the Leon & Stang CPAs. I'm happy to be here with you today to bring you this important information on behalf of the Northwest Tax Group, a subsidiary of Northwest Federal Credit Union. In this video, I'll talk about tax deductions and credits, gift and estate taxes. We'll talk about home purchasing and mortgage strategies a little bit, the tax treatment of retirement and investment plans, and let you know what has changed with the new tax law, which I know everybody is interested in. So let's get started. The first couple of items I wanted to cover were just a couple of definitions. The first one is adjusted gross income, which is essentially the number at the bottom of the first page of your 1040. That number is important to know because there are many items that are subject to phase-outs, like whether or not you can deduct student loan interest or whether or not you can contribute to a Roth IRA. Those figures, or whether or not you can do that, are dependent on what your adjusted gross income is. And being able to plan where that might fall would help you potentially be able to contribute to a Roth IRA, as an example, if that was of interest to you. Another number that's important to know, because this affects what tax bracket you're in, is your taxable income. And that is simply your adjusted gross income less your itemized deductions and your dependency exemptions. I'll come back to dependency exemptions again because those are being eliminated now with the new tax law. But for purposes of what we're going to talk about today, subtracting your dependency exemptions and your itemized deductions from your adjusted gross income is how you get to your taxable income. And then the other piece is knowing what tax bracket you're in, because that's extremely important to know what the value of a deduction is for you, or how an additional dollar that you make might be taxed. So for instance, if you're married filing joint, you're in the 25% tax bracket if your taxable income is between about $75,000 and ends at about $153,000. So if your taxable income falls in that range, your tax bracket is 25%. Also important is now with the new tax law, a lot of individuals are worried that they're actually going to end up owing more taxes because certain deductions have been reduced or eliminated. But it looks like because brackets have fallen and incomes that fall into those brackets are actually a little bit higher, we're feeling that many people are actually going to be a little bit better off under this new tax law than they were under the old tax law because rates have been lowered. I'll come back to that in a second, but just let me say that there's a lot of complex information here in this new tax law provision, as well as just some of the things we're going to cover normally. If any of you have any questions or feel like you need extra help, we're available to assist you either with the preparation of your taxes or with a tax consultation. And the way that you can inquire about that or sign up for that is if you go to the website at www.nwtgllc.com and go to the Contact Us page and fill out the information there. Someone will get in touch with you about a consultation or about setting up an appointment for your taxes. So we'd love to work with you from that standpoint. If you have seen the brackets for the new tax law, and I'll focus again on that range of income as I went through before on the 17 brackets, but now we have, instead of having a 25% bracket, we now have a 22% bracket. And again, for married joint, you fall into that income, you fall into that tax bracket at income between $77,401 and $166,000. And so, as you can see, that bracket has been expanded and the rate has been lowered. So I think a lot of people, even though they may lose a few deductions, are going to at least be neutral because those rates have been lowered. Some other issues to remember, just that we've had for a while, but I just want to point out. We do still have the what's called the Medicare surtax. That was part of the Affordable Care Act. The Medicare surtax could be a 0.9% surtax on wages. If you're married, if your wages are more than $250,000, you do have this 0.9% surtax on wages above that level. And also married, and by the way, for single, that would be income of $200,000. But for married, with adjusted gross income above $250,000, there is also a 3.8% surtax on investment income. So you might say, okay, long-term capital gains are 15%, but if your income is above that level, there's an additional 3.8% tax on capital gains if your income is above that $250,000 threshold. I usually bring up in these presentations the Social Security wage max. For those of you that pay Social Security taxes on your wages, in 2017, the Social Security wage max was $127,200. That has increased in 2018 to $128,700. So if your wages are above that level, you stop paying Social Security tax once your wages get above that. Some other items just to go over, and I'll have a more definitive list towards the end, but some of the things that are coming out now with the new tax law in 2018. Many people in our area here will itemize their deductions. When your itemized deductions, your mortgage interest, your real estate taxes, your state and local taxes, your charitable contributions exceed the standard deduction amount, you would elect to itemize. In 2017, the standard deduction is about $6,500 for single and about $13,000 for married couples. Under the new tax law, the standard deduction has been increased, almost double what it was last year. So the standard deduction for single individuals is $12,000 in the new tax law and $24,000 for married couples. And so what will probably happen is less people will ultimately itemize their deductions than before, because you'll always take the standard deduction if that figure is higher for you. Another item that may keep some people from itemizing is the fact that state and local taxes and real estate taxes have been capped in 2018. So a combination of real estate taxes and state taxes, that is now capped at $10,000, and that's for whether you're single or married. So, you know, around here, maybe you have real estate taxes of $5,000, state taxes are $7,000 or $8,000. You're capped at $10,000 for that total. Mortgage interest is only deductible on debt of up to $750,000 in the new tax law. That is for new loans only. So if someone has a mortgage, let's say a $900,000 mortgage, all of that interest is deductible under our old law, and so if that loan is in place as of January 1st of 18, everything is grandfathered in as far as that's concerned. But new loans, the interest is only deductible on new loans of up to $750,000. Again, in our area here in Northern Virginia, not all that hard for some people to reach that limit. As you heard about the new tax law, at first it looked like medical expenses were going to be eliminated from the new tax law. They actually made that better than it has been. So in 2000, under the old law in 2017, medical expenses were only deductible if they exceeded 10% of your adjusted gross income. For 2017, so this is retroactive, and also for 18, the threshold for deducting medical expenses is now 7.5% of your income. Still not a lot of people reach that limit, but that limit has been lowered, so it might be a little easier in 17 and 18 for some people to deduct medical expenses. Again, I mentioned earlier personal exemptions, so that exemption you take for yourself or your spouse or your children have been eliminated under this tax law. I'll go ahead and say now, and I may come back to it, the child tax credit has been expanded. So If you have children and you're thinking, I don't get that exemption anymore, that's a terrible provision, the child tax credit has now gone from $1,000, so that a credit being a dollar for dollar reduction of your taxes, that's been doubled to $2,000. And for those of you that do have children, you may remember that you were phased out of that credit very quickly. The phase out for when the child tax credit starts to go away is now $400,000 of adjusted gross income for married couples. Now it's only $110,000 for single, which seems a little unfair, but again, for married couples, that child tax credit has been expanded to where it doesn't phase out until income hits $400,000. Other deductions that have been eliminated, there's a category on the Schedule A called miscellaneous itemized deductions. Those would be your unreimbursed job expenses, maybe your tax preparation fee, maybe investment advisory fees. And the total in that category had to be more than 2% of your adjusted gross income before you could deduct anything. But all of those deductions have now been eliminated. And then lastly, and not many people were affected by this, but because it looks like itemized deductions will be reduced, there used to be something for those at higher income levels called the itemized deduction phase out. If any of you were hit by that, you would know it. That has also been eliminated in the new tax law. So I'm going to shift a little bit to estate taxes and just go over a couple of quick items. And 17 has passed, but now that we're into 18, the exemption for where you can pass assets to your heirs without any tax on those assets has now doubled. And that number is roughly, actually I think it is exactly $11 million per person that can pass to your beneficiaries without any estate tax. And so a married couple can actually pass $22 million of assets to their heirs without any estate tax. So that pretty much covers just about everyone. And of course in Virginia, there is no estate tax at all. So most people would not pass, would not have any tax on passing assets to their heirs. However, it is a combined, what we call the combined estate and gift tax. So there is this idea, I get the question a lot, that I can only gift $14,000 a year to a child, or to any person, as a matter of fact. And that is true. To gift to someone without any documentation at all, that limit is now $15,000 per year in 2018. But when you make an excess gift, all you're really doing is reducing the amount of your estate exemption by the amount that you're over that $15,000. So an example that I use is if you wanted to give a gift to a child to make a down payment on a house, and let's say that gift was going to be $115,000, you're $100,000 over the limit of 15, but all that means is instead of being able to leave $22 million without any estate tax, you just reduced the $22 million by $100,000 down to $21,900,000, and so many people aren't too worried about that either. So just a quick note, to make excess gifts or larger gifts is not, it really isn't, if you have the wherewithal to do that, it's not a tax burden to do that. So again, that may be an item. If you have any questions, you might want to make an inquiry and we can help you work through that. As far as retirement plans go, in 2018, the amount that you can defer into your thrift or your 401k plan is $18,500. And if you're 50 or older, you also have the catch-up contribution that you can make, so the total would be $24,500. Now, I know I work with a lot of people that are just starting out. We talk about $18,500. There's no way they're going to really defer that much, but if you are just starting out in your career or you know someone who is, the advice there would be to look at the match that they get from their company. So for instance, a company might give a 50% match on the first 6% of your salary. So they'll match 3%. If the employee puts in 6% of their pay, they get a 3% match. It doesn't seem like a lot, except that is a 50% return on the money that they're investing. If that person invests $1, the match is 50 cents. And so you're not going to get that return anywhere else on your money. So for someone starting out, it's not really about whether they can get 18.5 in deferral, but they do want to, as quickly as they can, get to that point where they're getting the maximum match from their employer. That would be the strategy there. And of course, if you're nearing retirement, you've worked hard to get your kids through school or those other things, and now it's all about you. You would want to try to accelerate that deferral and use the catch-up provision too to get that money put aside for retirement. If you're self-employed, there's a plan called a SEP, or also a solo 401k. In a SEP plan, you can put away about 20% of your net income into these self-employed retirement accounts. So if you have a Schedule C and you're a consultant and you've made $100,000, you could put about $20,000 into a SEP. So that's actually a pretty powerful plan. And even quite a bit more than that if you have the cash flow to do it in using a solo 401k. Here at Northwest, and I'm doing the tax part of this, but Northwest Capital Management, which another subsidiary of Northwest Federal Credit Union, is set up to provide holistic financial planning, really covering all the pieces that make up your financial success. So the advisors here at Northwest Financial can help you with the retirement plan concepts, and I work with them a lot on the tax side. So we're working back and forth quite a bit. Definitely take advantage of looking at that as well. Charitable deductions, if you've looked at the articles or whatever, everybody's saying that charitable donations are not as valuable under this new tax law as they were under the old law. The reality is the law has not changed at all related to charitable donations. Charitable donations are still deductible, but they're deductible if you itemize. And so for those that are looking at this new higher standard deduction and realizing that they may not hit that $24,000 that allows you to itemize, then it does make charitable donations a little less valuable. Of course, there are lots of good reasons to be charitable, but from a tax standpoint, it might not be the break that it was under the old law. One of the strategies that we're working with people on is how to bunch your charitable donations into 1 year. And so an example would be if you normally contribute $10,000 a year, which is a pretty hefty amount, but you're realizing that even if you do donate $10,000 a year, you still may not hit the $24,000 threshold to go over the standard deduction. You might bunch, as an example, 3 years of donations at once, $30,000. That year you'd be able to itemize and then not make those donations in subsequent years, you would then use the standard deduction and probably have a bigger tax benefit across those 3 years. So again, not many people will use that strategy, but if that's of interest to you, we could help you work through that. A couple of other changes that were made in the new tax law, and these are very, very minor. It used to be that only 50% of your adjusted gross income could be used as charitable donations. Not too many people I work with run up against that. But in case that wasn't enough, now that limit is 60%. So that did change. And just a couple of other little weird things, I thought. For those of you that might contribute to your college athletic fund, that donation is no longer fully deductible if you receive tickets in exchange for that donation. That will be limited in the future. So I'm going to shift into talking about your investments and some tax strategies related to investment income. We did talk about those at a higher income level may pay that Medicare surtax of 3.8% on your dividends, interest, capital gains. But also remember that dividends as well as long-term capital gains for most people are only taxed at 15%. There's been no change on that rate in the new tax law. There is a provision for those at very, very high income levels, and we're talking about 500,000 and above, where the tax on dividends and capital gains is actually 20% if your income is above that level. A particularly unknown provision with capital gains is that if you're otherwise in those lower brackets, so let's talk about what is now the 10% or the 12% bracket, that's income up to about $78,000 if you're married, that's taxable income. Capital gains and dividends are taxed at 0% as long as your total income is below that threshold. So in a year where you may have very low income, maybe a year that you retire, you could potentially get some capital gains or dividends and pay no tax on those at all. Again, I'd be happy to talk to you about that further if you're interested. A couple of other issues on capital gains where I get a question a lot. People are always wondering as to why they're limited to taking $3,000 of capital losses on a return. The item there is that's really your net capital losses. So if you sell a stock for a $10,000 gain and sell another stock for a $13,000 loss, you can net those two together and the net is negative $3,000. So you can use the full $13,000 loss against your $10,000 gain. If your losses end up being more than negative $3,000 in total, any excess can be carried over to future years. Retirement plans, we did talk about the 401k and thrift plans and the limits that are available there. In addition to that, everyone actually can contribute to an IRA. The question is, first of all, is the IRA deductible or not? So if you're a participant in a retirement plan, again, for those that file married jointly, if your income is above $99,000, you are limited or potentially phased out of deducting any regular IRA contribution. Another type of IRA is called a Roth IRA, and actually it's pretty powerful, especially for those that are young. If you put $5,500, that is the cap in 2018, into a Roth IRA, you don't deduct the money going in, but any money that's pulled out later, whether it's the original contribution you made or your earnings, is totally tax-free. So if you were 25 years old and you were able to put $5,500 into a Roth IRA and let that grow over the years and be able to pull all of that money out tax-free, that would be a huge benefit. There are some income limits, as with everything, on Roth IRAs as well. They're quite a bit higher. If you're single, you lose the ability to contribute to a Roth IRA at about $110,000, $115,000 of adjusted gross income. For married, that threshold is right around $200,000. So at a higher level of income, potentially you can contribute to that Roth IRA. And also similar to the 401k, if you're 50 or older, there is that catch-up amount also for IRA contributions. That is an extra $1,000, so 50 or older, you can contribute up to $6,500. And by the way, the catch-up, that is the year that you turn 50. So if you're turning 50 this November, here in 18, you can actually start contributing to that catch-up now through your thrift. Lastly, on the Roth IRA piece, many 401k plans, as well as the thrift plan, have what they call Roth sections or Roth provisions, so you can actually defer some of your money into that Roth feature, and again, not a deduction going in, but that money is tax-free coming out, including all of the earnings on that money. And just lastly, I'm going to go through some more provisions of the new tax law. Some of these I covered. I may repeat them again, but I'll emphasize them anyway. Tax brackets have been lowered. Instead of, for instance, instead of a 25% bracket, we now have a 22% bracket. And again, those tables we can provide to you if you were to inquire at the website. The standard deduction has been increased. For singles in 2018, that's going to be $12,000, and for married, that will be $24,000. But personal exemptions have been eliminated in the new tax law. Replacing those personal exemptions is a doubling of the child tax credit. Now instead of being $1,000, it's $2,000 per child per year. That's for kids that are under 17. So, those college-age children are not necessarily going to get a tax break anymore, even though they're very expensive at that point. And again, a lot of people got phased out of the child tax credit before. If you're married filing jointly, the phase out for the child tax credit doesn't start until your adjusted gross income hits $400,000. For mortgage interest is not deductible on mortgage debt that exceeds $750,000 under the new law. That is only for loans, for new loans taken out after January 1st of 2018. Real estate taxes and state and local taxes, that's a combination, are capped at a $10,000 deduction. I get a lot of that questions come up a lot. It's not both it's both together, not $10,000 for real estate and $10,000 for state and local. It's $10,000 for that combined category. The medical expenses threshold used to be, it had to be above 10% of your AGI. That's been reduced to 7.5% of your AGI for 2017 and 2018. After that, it goes back to the 10% threshold. This got a lot of publicity. I don't know how many people it really affects, but the mandate to have health insurance has been eliminated in this new tax law. So it is not mandatory that people have health insurance. That means there will be no penalty charged for 2018 and beyond if someone does not have health insurance. Some of you may be subject to the alternative minimum tax. That's a whole separate subject to go through what that's all about. The good news is that because of different thresholds and exemption amounts, there will be much fewer people subject to the AMT than there were before. So where we used to say once you were into the AMT, you never got out, maybe that's not the case anymore. Maybe you actually will be getting out of the alternative minimum tax if you've been subject to it before. There was a lot, perhaps, you heard about the fact that alimony as a deduction has been eliminated. That is true. That is after 2018, and that is only for divorces that are finalized after 2018. So if a divorce happens after 2018 now, alimony would not be deductible, nor is it included as income by the recipient. But for anyone who is paying alimony now, alimony would still be deductible. And as I mentioned before, the estate tax limitation, or the amount of assets that you can pass to your beneficiaries without any estate tax, is now up to $22 million for a married couple, $11 million per individual. But there are easy provisions within that law where a married couple can actually pass up to $22 million of their assets tax-free. Lastly, and this is an incredibly complex provision in the tax law, but for those of you that perhaps are consultants and have either income on a Schedule C from consulting, or maybe LLC income, with a lot of exceptions and a lot of provisions, it is possible that you can actually get a 20% deduction of your net business income right off of your taxable income. So if your Schedule C is $100,000, and this again depends on a lot of factors, but it's possible with that $100,000 Schedule C income, you may actually get a $20,000 deduction called the pass-through income deduction. Once again, we're talking to a lot of people about how that would work for them. So if any questions about that, that one we need to schedule something. This is a presentation from the Northwest Tax Group, which is a sister company of Northwest Financial Advisors, Northwest Title and Escrow, and the Northwest Insurance Agency. The taxes are just one part of a holistic financial plan, and Northwest is here to help you simplify your financial life. If you would like a copy of the presentation, you can also email and request that. We'd be glad to send that to you. Just send an email to info@nwtgllc.com. Thank you.